Three roads diverged in a yellow wood. Oh, wait a sec. That's not the poem. Hey, the Oak Harvest investment team have often asked about scenario analysis and other potential outcomes for the stock, bond, and financial markets. This makes sense, as no one's crystal ball is perfect each and every year. Given it's year-end 2024, we already alluded to our best guess for now as to where the markets end in 2025. That's 6660 currently, as well as the optimistic repeat of Trump 2.0, S&P 500 equals 7,000, and everyone else's 2025 outlooks have been posted. I figured I would leave our followers with three scenarios for 2025, along with historical precedents that you could follow along if you want to. Let's call them the great, the good, and the ugly. First off, investors, the great scenario. We've discussed this one multiple times, even back in the third quarter of this year in front of Donald Trump, who won re-election in early November. The great for 2025 is Trump 2.0 in 2025, mirroring Trump 1.0 of 2017. Take a look at the three overlays of the most important charts for that scenario. First, the S&P 500, then the 10-year Treasury yields, and finally, the DXY dollar currency basket, which I personally think will be the key to 2025. Recall that 2017 turned out to be Goldilocks on steroids for investors and a nightmare for traders. Why? Because the biggest drawdowns throughout 2017 amounted to barely minus 3.5%, and after the first quarter, the max drawdown in the S&P 500 ranged from about minus 2.5% to minus 1.5%. 2017 was glorious for bulls because earnings surprised to the upside on the back of a decent economy, long-term interest rates declined on the back of a Fed that was raising rates, and an economy that was slowing, as well as inflation that was gradually declining. Throw into the mix, the dollar went on a 12-month sell-off that boosted other global assets in markets such as China, and if you were long most everything except for energy, you made money. A repeat of all of those things can get the S&P 500 to around 7,000, but my work says that volatility must collapse back below 12 like it did in 2017 and like it was doing in realized volatility markets pre-election in late November of this year. Okay, the second scenario is merely the good. What's the good in our work? It's about 6660 on the S&P 500, which would be about plus 12 to 13% from our 5,900 currently on the cash S&P 500. The good is a continued soft landing in the economy. Higher earnings, flattish long bond yields, and peaking to stable dollar. The good scenario anticipates a range of normal volatility that we've experienced over the last 10 to 15 years, leaving out the COVID collapse. That's a range of implied volatility futures, say from 14 to 22.5. I said volatility futures, not the spot VIX, as I found little to no study linking the level of spot volatility to equity returns. The trend, yes. And the level relative to the forward volatility that's actually traded? Sure, but there's no actual spot volatility. That's a calculation. The best historical precedent for this one is probably 1994 through 1997, with 1995 being the year we experienced comparable to 2024. We actually discussed this 95-96 period early this year, as many doomers were calling for crashes and economic calamity. Why did we reference this one? Well, that's one of the few times in stock market history that the Federal Reserve was actually able to engineer an economic slowdown without causing a dramatic economic downturn, a recession, or a financial collapse in the markets. Back then, Alan Greenspan and the Fed cut rates from 6% to 5.25% over 6 months in the second half of 1995, cooling the economy without tanking it. As much hysteria as there is in the current financial press about rising long-term Treasury yields, even back then, U.S. Treasury yields ended higher in the 12-month period following the first rate cut. Overall, bond total returns trailed cash returns, meaning you wanted to stay in shorter-term maturity Treasuries for the soft landing. Here are those same three charts: the S&P 500, the 10-year Treasury, and the dollar index from 1995 and 96 overlaid with 2024 and 2025. 1996 still saw a soft landing for the economy, but market volatility ratcheted higher throughout the first half of 1996. Current forward volatility markets suggest a similar scenario might unfold in 2025. Investors, in this scenario, the bull market would continue running in 2025, ending the year overall higher, But the bulls might pause in late February, spending much of the late first quarter of 2025 and second quarter of 2025 navigating higher volatility under this scenario. Just to remind those who weren't investing in 1995 and 96, the S&P 500 started the year in 1996 on a bit of a sour note, selling off for the first few weeks of about minus 3.5%. But then it found its footing into earnings and rallied strongly to put the index up around 6.5% to 7.5% into April. However, investors, overall, post mid-February of 1996, the S&P 500 did nothing net except trade in a very wide range through late July. During the summer of 1996, the S&P 500 got to up about 10% on the year, but it then sold off minus 9.5% to 10% in a summer swoon before regaining its footing and ending 1996 on a very, very strong note, with the markets up about 20% on the year. Okay, the third and final scenario, one which we continue to think is highly unlikely. Yes, it's the ugly. It's a repeat of the dot-com peak and the tech collapse, with the AI and Bitcoin being this cycle's bubbles. It's the 2024 repeat of the 1999 euphoria and the Fed reversing course in 2025 and actually raising interest rates, killing both the economy and the stock markets. Investors, take a look at what that overlay might look like for the S&P 500. Yes, that would be ugly. It would have 2025 being 2000 and the Fed creating a policy mistake by raising short-term rates and the dollar breaking out to new multi-year highs, hurting earnings and other global economies. Investors, in this scenario, it would have the best trade being the S&P 500 prints its high for 2024 on the last day of the year, which would feel great. But the trade would then be to sell every rally of the S&P 500 up over 3 to 5% on the year through late August. Let's call that 6180 to 6300 cash S&P 500 all year, and then short everything on monthly rallies for 18 to 24 months. As recall, after the summer 2000 peak, the S&P 500 fell almost 18% into mid-December 2000, closed 2000 down 10%, which would be about 5,400 now. Then it fell minus 38% in September of 2001 and down almost 50% before it was over in September of 2002. You can do the math on those outcomes, but we do not currently think this ugly dot-com bubble burst is a likely scenario over the upcoming few years. That said, investors remember that a run-of-the-mill recession in these stocks has the S&P 500 down minus 25 to minus 35% from peak to trough. Yes, those are normal recession downturn numbers. We had an earnings recession for 6 months in the first half of 2022, even though politicians and economists still want to debate that one. Remember what stocks did back then? The S&P 500 dropped minus 25% peak to trough, and add in the inflation near 10%, and you get almost a real return drop of minus 35%. Folks, that's a recession in the markets. Investors, going forward, a run-of-the-mill recession from here in the US would equate to about 4,550 to 4,000 on cash S&P 500 in my work. That is not a pleasant thought, but we will have a recession again in my lifetime. So that's it, my scenario analysis for 2025. 3 what-if outcomes, let's call them the great, call that Trump 2.0 echo. The good, call this one the long soft landing. And the third one, the ugly, call it AI for avalanche in progress. The dot-com bomb, history repeats. For now, scenario 2, S&P 500, 6660 is my likely outcome, with the Trump 2.0 as the next likely candidate and the AI avalanche unlikely for now. These 3 scenarios all bear watching, and the team at Oak Harvest Financial Group will keep an eye on the real-time, real data and try to keep you informed with what we're thinking, regardless of how 2025 should play out and whether our crystal ball is seeing the fat pitch well or just seeing a lot of clouds and a lot of fog. But investors, before you dismiss myself or the likes of Tom Lee, who says 7,000 plus, or Rich Ross, who've been more right than wrong over the ongoing bull market in favor of those retired billionaire hedge fund managers or doomers like Jeremy Grantham or Robert Kiyosaki or other newsletter writers who keep trying to scare you and have been horribly wrong, ask yourself, have they been right? Have they been right lately? Have they been right consistently? Or were they just one-hit wonders from years, if not decades ago? Keep popping up in your social media feed because of a catchy computer algorithm that knows your age, knows your gender, knows your political beliefs. My suggestion to you investors is, with 2024 coming to a close, talk to your financial advisor, walk through your financial plan and determine if you and your money are taking the right amount of risk given your current spending and budget, and determine if you are taking too much or not enough risk to meet your longer-term retirement goals. And with that, the Oak Harvest team wishes you and your family a blessed holiday and have a happy new year and ahead in 2025.